As a stock trader, your money management strategy is the one variable that will give you the biggest edge in trading stocks. You cannot control the markets, but you can control your money and your risk on each and every trade that you make. However, it is important to note that every smart investor wants to minimize risk while maximizing profit potential. Yet conventional investment theory tells us that in order to increase returns, you have to increase risk. Here are some techniques which you as a potential stock trader can apply when using Investhrone. When you are selecting stocks to build your portfolio in a real-life situation, it is recommended to put some attention into picking out stocks that are so cheap that they are the least likely to go down any further. If they actually do go down, you would be able to buy more of them because at those prices, you could buy the whole company and sell off the assets for a profit. This is a useful fail-safe whenever your cash is invested in cheap stocks. And from this group of cheap yet safe stocks, you select the ones that are most likely to large appreciation in value. A stock can be considered cheap by most investors if it sells below the liquidation value of its assets, and most cheap if it sells anywhere near the net amount of cash it has on hand. Thus, the first two measures of value you should be noting would be the book value per share and cash per share. Book value is the value of the shareholders' equity carried on the books of the company. Generally, since you are buying a share of stock, you will want to know the book value per share. The only downside of looking at book value is that companies often have intangible assets on the books, goodwill and the like. It would be wise not to pay too much attention to the company's intangible assets but instead focus on another safe measure, which is tangible book value. And you shouldn't bother calculating the book value manually, as book value per share is often calculated for you in the various internet financial stock search programs available such as Yahoo Finance and Thomson Reuters. The next indicator to look for is cash per share or working capital per share. Working capital is current assets minus current liabilities. These assets are near to cash or will generally be turned over in 1 year, receivables, inventory and the like. To measure the financial health of working capital, divide current assets by current liabilities to get the current ratio. A current ratio of 2 to 1 or better usually indicates a solid company. As long as the company does not have any long-term debt, or at least none coming due in the near future, the company is solvent and should be around for a while, little or no bankruptcy risk. Next, we look for low price earnings (P/E) ratios. Buying high P/E stocks to chase growth companies is inviting real risk. If the company disappoints in earnings, not only will the stock drop from lower earnings, the P/E ratio will deflate as well, giving you a double hit on losses. Alright, let's take for example that you have indeed managed to find a company that is selling at or below book value with a current ratio better than 2:1, and a low P/E. It is highly likely that the stock will not go down, but you gotta have to ask yourself the other question: will the stock go up? You can start off by looking at the ratio of revenues or sales to market values or the dollar amount of sales per share. Generally speaking, the company with a relatively high amount of sales per market value or sales will have more action on the upside. That company has more revenues to make profits from. After you have narrowed the field using the above techniques, you will have to do some intensive research about company prospects to find out which of those cheap stocks that truly give you superior returns, so that you will be able to maximize your stock profits after reducing the risk. I hope you have learned something from this video.